Good day, attorney. I'm Ms. Isabel D. Quina, and I will be discussing part 1 of our report on Section 42A of the NIRC. We're going to be unpacking this crucial provision, which is all about defining what counts as income from Philippines. This is a core concept in our taxation one, and it's essential for understanding how we tax both locals and foreigners. The goal is to move beyond just reading the law and really understand it. We look at the text, but we'll also explore why behind it and see how the Supreme Court has interpreted it over the years. So this session is structured to be interactive. So feel free to jot down notes. So what is Section 42A? So to give us a roadmap, let's start with a quick overview of what is what and why of Section 42A. So Section 42A is a definitive list. It tells us exactly which types of gross income are considered from sources within the Philippines. Why is that list is important? Because our tax system is a hybrid. For non-residents, foreigners earning here, we only tax income that has a Philippine source. For residents, this list is just as important because it helps them compute their foreign tax credits, preventing them from being taxed twice on the same income by the Philippines and another country. It's the bedrock of our source-based taxation rules. So, core principles. What are the big takeaways? First, the sourcing rules prioritize where the income is earned, what we call situs, not the taxpayer's residence. We see this clearly when we tax a foreign company for services performed here. Second, these rules interact directly with Section 23, which classifies taxpayers. A non-resident alien's taxability is entirely dependent on this section. And finally, our courts have been busy. They've shaped these rules from very early years, like in the case of El Oriente Fabrica de Tabacos versus Posadas in 1931, which clarified that not every money in flux is income, to modern doctrines like the economic nexus test in 2022 in the case of ACES Philippines versus Commissioner. The law is not static, but it evolves. The central idea. So here's our central argument. So Section 42, income from sources within the Philippines. First, we have the interest derived from sources within the Philippines, and interest on the bonds, notes, or other interest-bearing obligations of residents, corporate or otherwise. Dividends, we have the domestic corporation and foreign corporation. Third, services, compensation for labor or personal services performed in the Philippines. 4 is rental and royalties. Rental and royalties from property located in the Philippines or from any interest in such property, including the use or right or privilege in the Philippines of copyright, the use or right in the Philippines of any industrial to supply of scientific, technical, industrial, or common knowledge, the supply of any assistance, the supply of services by a non-resident person or his employees, the use of right to use motion picture films, tapes, and total or partial forbearance with respect to the use of the right to use property. And fifth, we have the sale of real property. And sixth, sale of personal property. So Section 42 is the embodiment of the source-based taxation principle. Its mechanism are government uses to assert its fiscal sovereignty over income generated within its borders, while simultaneously providing the framework to mitigate double taxation, a balance that has been refined and clarified through a landmark jurisprudence. So where does sourcing rules come from? So the idea of sourcing income isn't new. It's been in our tax code since at least in 1939 Tax Code Commonwealth Act number 466, and has been carried through to the 1997 NIRC as we use today. So the drafters of these laws were heavily influenced by international models like the League of National Model Tax Treaties, which were treated to solve a fundamental problem. In a world of global trade, which country gets to tax a particular stream of income? The concept of source was the answer. it looks to the origin of the economic activity or benefit. So if the activity that produced the income happened here, or the property that generated it is here, the Philippines has the right to tax it. So Philippines equals hybrid tax system. So this brings us to why this is so vital in our hybrid system. As we learned in our class, our residents, individual, and corporations are taxed in their worldwide income under Section 23, but non-residents are taxed only in their Philippine income. Section 42A is a tool that draws that line. A classic example is the Supreme Court case of Commissioner versus British Overseas Airways Corporation. A foreign airline had no physical office here, but it sold tickets for flights to and from the Philippines. The court said those sales generated income from a Philippine source, and therefore, British Overseas Airways was subject to Philippine tax. The source was a sale transaction occurring here. What Section 42A does? So, the provision's purpose is twofold. First, it defines a taxable income base from non-residents. Second, it helps the residents apportion their income for foreign tax credit calculations. Its scope is defined by the 6 specific categories of income we're about to study, but it's just as important to know what's not in its scope. For instance, it only deals with gross income, which, as the L. Oriete case taught us, means an accretion of wealth, gain. Simply receiving your capital back is not income and thus not covered here. So Section 42A, so provided you with a full text. So why are we spending a whole session in this? Because it connects directly to everything. It links to Section 32, the definition of gross income, to specific status rules. It's crucial for determining the tax due for different types of taxpayers: individuals, corporations, residents, non-residents. And yes, its favorite topic in the bar exams, often disguised as questions about the status of income from services or online transactions. Mastering this section gives you a huge advantage. Understanding the language. As we look this list, few concepts in mind. First, gross income. Here still carries its meaning from Section 32. It must be a gain or profit, a return capital, not a return of capital. Second, think about the siders or taxing hook for each category. For interest and dividends, the hook is often the residence of the taxpayer. For services, it's a place of performance. For rentals and real property, it's a location of the property. For personal property, it's more complex and requires apportionment. Section 42A in the bigger picture. So, Section 42 doesn't exist in vacuum. It interacts heavily with other parts of the tax code. Most importantly, it works hand in hand with Section 42B, which tells us how to allocate deductions against this income. It also ties back to Section 23, taxpayer classifications, and forward to Section 34, allowable deductions. When we talk about income from the sale of personal property, Section 42A6 explicitly sends us to Section 42E for the actual rules on how to source that income. It's all interconnected. So Section 42A, interest. So interest, income is sourced in the Philippines if the debtor or obligor is resident in the Philippines. So a Philippine company borrows money from a bank in New York, the interest it pays that New York bank is considered Philippine source income. The Supreme Court affirmed this in case of Commissioner versus Mitsubishi Metal Corp, where a Japanese corporation earned interest from Philippine corporation. The court held that since the payer was Philippine-based, the interest income was from a Philippine source, regardless of where the loan agreement was signed. So Section 42A, dividends. We have the domestic corporation and foreign corporation. So domestic corporation, all dividends from a Philippine domestic corporation are 100% sourced. The logic is that domestic corporation owes its very existence to Philippine laws, so its distribution are always considered from here. Second, from a foreign corporation. This is where it gets interesting. A dividend from a foreign corporation is only partially considered Philippine source if that foreign corporation earned at least 50% of its gross income from Philippine sources in the 3 years before the dividend was declared. Why? To prevent a company from being a mere shell that passively holds Philippine assets to avoid taxes. If it meets a 50% test, then only the proportionate part of the dividend that matches its Philippine earnings. It is treated as Philippine source income to the recipient. Section 42A. Services. This rule is simply in concept but can be tricky in application. The income is sourced where the labor or personal services are physically performed. If a software developer from India flies to Manila and works in BGC for 6 months, the income from those 6 months is Philippine source. The case of Baer Nickel versus Commissioner is a great illustration also. The taxpayer was hired abroad but her work involved marketing promotional activities in the Philippines. The court said that's enough. The services were performed here, so the income is sourced here. More recently, in the case of ACES Philippines versus Commissioner in 2002 grappled with the modern economy. The case involved satellite services provided to the Philippines. The Supreme Court introduced the economic nexus test, asking where the economic activity that generated the income took place. Even if the satellite is in space, if the benefits and activities are consumed in the Philippines, the situs is here. This is a huge development for taxing digital services. Section 42A4, Rentals and Royalties. This category is very broad, purposely designed to cover the modern knowledge economy. The key phrase is used in the Philippines. It covers traditional rentals from property located here. For example, a building in Makati. It covers royalties for using intellectual property in the Philippines, like a patent for a manufacturing process used by a factory in Laguna or trademark license to a company in Cebu. So in subparagraphs A through G, list a wide range of technical payments for know-how, technical assistance, industrial equipment, and of course, the use of films and tapes of broadcasting. And the underlying principle is that if the benefit or use of the intangible right or equipment is enjoyed in the Philippines, the payment for it is from the Philippine source. The old case of Evangelista versus Collector affirmed that even simple rental income from property is sourced where the property is located. Section 42A5, Sale of Real Property. The situs here is the physical location of the property. It's that simple. Gains from selling a piece of land in Davao are 100% sourced, Philippine sourced, even if the seller is a non-resident and the sale contract is signed in Singapore. So the Villas versus Commissioner case reminds us that what is being taxed here is a gain from the sale. In the case, children who sold inherited lots on a profit were correctly taxed in a profit as income from a Philippine source. So Section 42A6, Sale of Personal Property. This is the most complex category. Personal property includes everything that isn't real property. It includes inventory, equipment, shares of stocks, intellectual property, and so on. The rule isn't as simple. So Section 42A provides a formula. Income from the purchase and sale of personal property is sourced where the sale happens. But for a Philippine resident selling property purchased abroad or a non-resident selling property here, the income is generally sourced where the seller is. However, the most important rule is for a resident engaged in business. Income from selling personal property produced in the Philippines but sold abroad or vice versa is partially sourced here. You apportion the income based on where the production activities and the sale activities took place. This prevents double taxation and international commerce. The case of Howden versus CIR dealt with the insurance contracts, which were considered personal property. The court looked where the contracts were affected and where the risks were located to determine the source of income, showing that for complex personal property, the analysis is multifaceted. So section 42A categories for your quick reference. So key takeaways for this part. So citus is everything. Always ask where was the income earned or used or paid. So know your taxpayer, resident versus non-resident changes the analysis. Cases illustrate the rules. Memorize the holding, not just a name. Section 42A is a list of its If it's not in the 6, check if it's really income at all. So what we covered today is executive summary and thesis, historical context, hybrid system, statutory text and key definitions, detailed breakdown of 6 categories, landmark cases for each. And that concludes part 1 of my discussion in section 42A. So the next reporter will be Laura Igaran.